Friday, May 7th here. And I'm in, of course, beautiful Bangkok, Thailand. Let's get into it. If you've got any questions, make sure that you put them in the chat. I'll answer any questions at the end of the presentation. So I'm just going to type that in. Put your questions in the chat. Just make sure we're all linked up. Yep, everybody's ready to go. So let's make it happen. All right, first story of the day. What a week it's been. There's been so much news. Let's get through some of it. Here's an article from the Wall Street Journal. Fed says COVID is major financial risk. Asset prices vulnerable to significant decline. Interesting. So let's look at this story. Investors should be cautious of overpriced assets. Fed report warned of a continued rise in risk-taking in equity and bonds. High valuations, high corporate indebtedness, and if containing COVID falls short, it could amplify a price fall. Of course, the objective of the Fed is not to manage the markets, but they are concerned about them. Now, reallocation of assets amidst the possible price fall. The Fed also argued that current market situation may be due to high asset prices that's coming because of low Treasury yields, and also low interest rates could justify. So there's kind of conflicting. However, the probability of a price fall is higher at these levels. Investors should consider hard assets, maybe property or commodities, and maybe even cash. The point is that you never know when the market's going to fall, and you never know. Ultimately, over the long run, the market rises. So we do expect that the market's going to rise over the long run, and so you may want to continue to roll with it. The reality is that the Fed is getting scared. They've pumped up this economy pretty massively over the years, and now there are risks out there. I did a study a while ago where I looked at buying the stock market in the U.S. based upon when PEs were low and when PEs were high. And basically, at this point, the probability of a positive 5-year return is very, very low for my perspective for the U.S. Next article was Fed's Kaplan in interviews says it's time to open discussions on tapping brakes on central bank support for the economy. So central bank is really starting to give some warnings. Basically, the rise of caution on the U.S. economy is overheating. Currently, Fed has kept interest rates close to zero and buys back about $120 billion in bonds per month to support the economy. The Dallas Fed's president suggests that the central bank should ease this support plan by reducing the number of bonds purchased to prevent next year's inflation. Well, the situation may not be as bad. Let's see. Data shows the Fed is meeting their goals, decreasing the amount of unemployment, increasing vaccinations, and accessibility is another thing. It's not necessarily the Fed's goal, but vaccination rollout. And continuation of expansionary monetary policy can lead to inflation overshooting and have a negative effect on the stock market. Now, I would basically say that we're in a very, very dangerous point because the Fed has supported the market for so long. Now, also, the next article is about gold being back above 1,800, but late to the inflation party. Gold prices back up to about 1,800, and that's up about 1.6%. After 10 weeks of kind of taking a break. Gold has been notably late in reflecting the rising concerns about inflation, but you could argue that inflation is really only starting to happen now. And there's plenty of people that think it's not going to happen. There's opportunities to hedge against future inflation through gold. From the U.S. economic data, we can see that home building, house prices, and employment have exceeded the forecasts. Investors could invest in other assets and commodities to hedge against inflation. Gold and commodities and tips are the things that tend to do well during inflationary environment. All right, next story. SEC chair says reviewing short selling and swap movings after GameStop and Archegos saga. So the rise of meme stocks has prompted the SEC chair to consider measures for big investors to disclose short positions or bet that stocks will fall. This was brought to the attention as the recent GameStop saga left the hedge fund, Archegos Capital, and banks that it's working with $10 billion. That's $1 billion in losses. And the higher regulations could put negative pressure on hedge funds for sure. A lot of hedge funds are shorting as opposed to most traditional funds are long only. The recent saga highlights the potential spillover effects on financial institutions. Truthfully, if the US economy or economies around the world don't start really strongly recovering, banks could be in a lot of trouble. And if future regulation to tighten short selling passes, it's likely to stop people from short selling. Now, generally, as a person who believes in the free market, I would say that's not a great thing. But also, we're at a very high risk place. And sometimes market regulators do implement tighter procedures at that time. Next article is about Chinese manufacturers sidestepping trade barriers by buying factories overseas. This is a sneaky little trick where they circumvent these trade barriers. US and EU are increasingly imposing anti-dumping tariffs on China. However, China companies across multiple industries are acquiring factories around the world, like tires in Thailand, steel in Indonesia, and railway in the US and Germany. And then we also can basically see that China's entry into the EU and US should help them gain greater access, which could lower tariffs. It's exactly what the US has done over the years, is bring their production operations to local economies. Lower tariffs and Biden's intention to develop rail transportation in the US should benefit the Chinese railway and steel companies. The company Hesteel and China Baowu Steel Group are two that could potentially benefit from this. Of course, you've got potential let's say, negative sentiment towards Chinese companies, and that could be a challenge for them in the US. Now, Ford, BMW joined cutthroat EV race with risky bets in new tech battery, a new battery tech. Car manufacturers are competing to create better and cheaper batteries. Ford and BMW are leading a $130 million Series B funding round in a battery startup to make cheaper and more efficient batteries. New electric vehicles, companies are required to invest for research and development. Tesla's R&D costs hit about $1.5 billion US dollars in 2020, 11% increase from 2019. And this is a significant issue because basically these car companies are struggling. Batteries are really the key to how to store and use. The great thing about cars and oil is that we can store oil in the ground, and then we take it out of the ground and send it to refineries, and then they store it in big like oil farms, basically, where they keep it. And then you put it in your car and you store it in your car, and you can use it at any moment in time. And that is a massive convenience in oil that is not something that's easily beaten by other energy sources. So large conglomerates could be attractive for investors as they have resources to buy smaller companies. So it's an interesting point because sometimes we talk about large companies aren't very innovative, but hey, they can buy other companies. So investors could also buy shares in companies that supply battery enhancing products like Intel, LG, and IBM. Speaking of IBM, this Reuters article talks about how it unveiled the 2 nanometer chip technology for faster computing. Let's look into this. The world's first 2 nanometer chip technology brings about a bright future. Maybe. IBM unveils the first 2 nanometer chip making technology, which allows a chip to pack more computing power on less space. As a result, this 2 nanometer chip will be 75% more power efficient and 45% faster than the 7 nanometer chip right now that's being used in laptops and phones. IBM basically bases its R&D center in the US. It currently outsources its chip production to Samsung in Korea. It also has JV or joint technology development deals with Intel and to use this IBM chip making technology. And the development benefits these three companies could, benefit from, could make them attractive. So these are some companies to watch, and that's some major news, I would say. Now, Visa, this article coming from FinTech Switzerland, fintechnews.ch. Visa teams up with Tala to drive crypto adoption among the underbanked. This article comes out of Switzerland. Let's see what they've got to say. Tala, a financial services provider, partners with Visa to assist underbanked populations worldwide. The potential market for Tala could increase exponentially from this move. So there are presently 1.7 billion people who do not have access to financial services. Connecting these underbanked individuals could be a source of revenue for banks that use blockchain and crypto by providing financial tools easily accessible to all. Of course, one of the big roadblocks to this has been the cost of blockchain and the cost of these types of transactions. So I think this is one to watch and see what's happening with the cost of transactions. Next one, car companies' profits have outrun the chip shortage, but not for long. Well, automakers such as Ford and General Motors have seen record sales during the first quarter. Of course, it's a bounce back from the crisis. However, semiconductor shortages have forced car manufacturers worldwide to halt production. GM and Ford have estimated this will cost them each more than $2 billion. Next, manufacturers that don't rely on semiconductors, such as Tesla, could benefit. And microcontrollers is what they're actually relying on. They require less semiconductor material than semiconductor chips, but are built for a specific application. Other automakers could follow suit, which could accelerate the recovery. I just read a great article about how Toyota has been planning on this since the Fukushima meltdown that happened there, which disrupted their supply lines, and they're not being impacted and taking a hit from it like GM and Ford are. Wall Street Journal article, UK open to US proposals for global minimum taxes. Get ready, everybody. It's time to pay taxes across the world. Well, the Biden administration proposed to set a global minimum corporate tax rate to limit tax avoidance by multinational companies. While the UK has not accepted US's corporate tax rate, they're open to negotiations, particularly related to the tech companies. France and Germany are also supportive of this global minimum corporate tax, and increased government tax money should benefit large European companies or countries' economies. Now, I just wanted to mention about this tax item. My whoops, sorry, I didn't mean to do that. There we go. My expectation is that the U.S. is going to issue a tax that all countries in the world are going to have to pay, and it's going to be paid for by these countries because the U.S. is providing them access to the global financial system that they now control, and they're being the policemen of the world. And this is a very bold prediction. It's not happening yet, but any cooperation that I see happening on taxes, I believe, are taking us closer. The point is that some countries basically can lower tax rates to attract big companies to come, and the result is that they get that business. But if they can eliminate this loophole, basically, or this opportunity for countries, it also means that, hey, the big countries are going to benefit, because if tax rates are the same across all countries, then I might as well just put it at the biggest countries. So there are countries like Ireland and other countries around the world that are probably fighting this. So let's see how it goes. All right. And this story, Treasury Secretary Yellen says rates may have to rise somewhat to keep economy from overheating. What's this one about? Well, basically, she's suggesting interest rate rises. And that's fascinating because we haven't heard the central bank talking about that. And of course, she's above the central bank at the Treasury. And the U.S. budget deficit has hit a record $1.7 trillion from October 2020 to March 2021. If interest rates were to increase, it would likely lead to some asset price pain, I would say. Now, the last article of today is U.S. trade deficit surges to a record shortfall with China, and that shortfall with China just keeps growing. Basically, the U.S. trade deficit increased to $74 billion in March 2021. This represents a 58% increase from March 2020. The rise in imports was mostly driven by increases in consumer goods, industrial supplies and materials, capital goods, and automotive vehicles, parts, and engines. Well, before I take questions, just to talk about that, the U.S. government, in fact, Donald Trump had made the promise that he would make America great again, and that, in fact, we would start exporting products from around America out to the world, and we would rebuild our trade balance. And, in fact, the trade balance is now, after his presidency, the worst that it's ever been. All right, let's take a look in the chat. We got some questions. Let's see. First one, yeah. Sean says, hi, greetings. Good to see you. Excellent. Ravi says, to what extent do you think that the current PE ratios are overvalued compared to fundamentals? I would argue that they're overvalued, particularly in some sectors. Keep in mind that the tech companies have been making tons of profits, and so the PEs were justified to some extent. Also, keep in mind, interest rates have been ultra low, and the Fed's been saying they're going to keep it low. So the discount rate when valuing an asset is going to be low, and so the result of that is that maybe it's been justified, but I would say there's a risk of a de-rating of the PE. All right, Sean says, warning, Fed warns of high leverage lurking in financial system. Yeah. So next one question comes in from Rahul Joshi. What opportunities are you observing in U.S. stock market? Cyclicals, growth, tech, value? I would say I would focus on value right now. I think value looks pretty interesting in the U.S. And, you know, you've already got momentum if you're owning, let's say, the S&P 500. So I would go look there. All right. Next, Somport. Nice to see you, Noom. What do you think about home building ETFs? Well, home building ETFs are rising because we've got costs rising. Well, actually, let's go back to the home building for a moment. Let's look at the home building sector. A major input in home building in America is wood, timber, and that is basically shooting high. So what you've got is a situation where the cost of producing or building a home has been rising in the U.S., and that ultimately means that the price of those homes have to rise too. The question is, can the market bear those increases, and are those increases across the U.S.? So for right now, I would say I would be a bit cautious on home builder ETFs, but I would say I haven't looked at them recently. Next question comes from Titikon. Is it only U.S. market that's dangerous, or is as dangerous every market? If you look around the world, generally you'll find that markets are not that expensive. It is the U.S. that is mainly expensive. Some other markets have risen a lot in the last 12 to 18 months, but generally it's the U.S., and particularly it's the tech stocks in the U.S. that are really expensive, which is why some people would argue, U.S. isn't going to collapse. Only the tech stocks will come down, but all the other stocks will come up. And if that's the case, we could see that the market actually doesn't crash. All right. Chris, as to what percentage should I allocate my investment to commodities? Commodities is not really a common asset class that people are adding money to. So it gets a little risky to go over. You know, many people would never even go over 10%. In my all-weather strategy, I've got it up to 25, but that's just for a moment in time. I may bring it down. So I would say if I was looking at it from an individual's perspective, 5, 10, maximum probably 15%. Remember, ultimately, equities are the things that we want to own. Okay, Munling says, is shorting stocks a good or bad thing, or does it depend? Generally, what we would say is in the stock market, I mean, I'm a relatively free market guy. In the stock market, we want to have buyers and sellers, and we want to have short. If a company, the reason why short selling is so valuable in the stock market is that there's a small number of men and women out there that just love to find fraud and find poorly run companies that are overvalued. And when they find them, they short those companies, and the prices of those companies come down. And for the people that are owning those companies, they don't like it because that's just brought down the value of their investment. But from an efficient market perspective, that helps keep the market efficient. So generally, I would say I like short selling. Now, if short selling is being used to manipulate the markets or to threaten companies, good companies, okay, that gets a little bit different. But I would generally say that I like short selling. It's interesting that in most countries in Asia, short selling is not allowed because they're just afraid. Regulators in Asia are actually somewhat tougher sometimes than the SEC in the US. All right, Sean says, sophisticated and smart investors who fathom history and economics have always taken positions in tangible assets, right? Real estate, gold, and silver. I wouldn't argue against that. Now, your next part is car is a luxury asset class. Well, guess what, Sean? I bought a 1963 Lincoln Continental 10 years ago. I was just telling the story to my valuation masterclass boot camp students, and I sold it later. I bought it 10 years ago, and I sold it for almost, let's say, 3.5 times what I paid for it. So yes, sometimes luxury cars can be valuable, but I'd say you got to be super, super careful with that asset class because it can also depreciate pretty quickly. Yachts and art. Yep, possible. Yep. Recent Samsung Lee family sold their arts to pay off income taxes in South Korea. Okay. So next one comes from Ravi. He said, Sean, what do you think about the rise in digital assets as a store of value? Sean, there's your question ready for you. And here it comes. Digital yuan is a good asset to take a position. Russia and China are moving their foreign reserves into gold and into the Chinese yuan. Yuan is a currency for the emerging markets. I was talking about yuan on January 1st, 2011 in New York. China is the new something, All right. Suchai says, for cryptocurrencies, what is your opinion about the exponential rise in value of coins such as Dogecoin that don't really have a strong fundamental base? I would say it's really fun to play in cryptocurrency with money that you can lose. It's a little bit harder when you're focused on money that you can't lose. And that's the reason why so many traditional investment funds, pension funds, all of these things just can't get into this because they run the risk of losing the money. And if they lose that money, it's never coming back. So I would say have fun in cryptocurrency, view it as a fun and a game. Maybe take a little position for the long term, but be careful. Make sure you're investing what you can lose. All right. Kritin said, could this global tax be large enough to sufficiently hurt large companies? I think there's some impact happening on large companies from this. And some large companies are in jurisdictions like Ireland and others where they've been getting lower tax rates, and that could harmonize, and therefore they would pay higher taxes. All right, next one. Kayin Aya says, global tax will be tough, especially for us in the tech industry. Yeah, in fact, it is tough. And the tech space is really the space, automobile companies have been paying taxes in France. If a U.S. automobile company wants to sell its products in France, because it's a physical product, they're already paying taxes. So you're correct in saying that this is going to hit the tech companies. Sean says higher taxes will lead to lower consumption and aggregate demand, for sure. It's possible that all it's doing is equalizing the taxes between countries, and so it may not have such a huge impact. Munling says, inflation seems imminent in the U.S. Do you think this will be the case in other countries? Well, generally what happens in the U.S. happens around the world. So I think we will have a wave of inflation that could go through the world. But I would argue that countries, and I particularly being in Southeast Asia, I see a lot of resilience there where we won't get hit so hard by inflation, but it will hit everybody. Just look at rising oil prices. Thailand, as an example, where we are, for instance, is one of the largest importers of oil in Asia. India is also a huge importer, and that means that if oil prices go up, just like everything's going up, these countries could struggle. But keep in mind that there's another element to this, and that is the potential devaluation of the dollar. And if the dollar devalues, it could mean that other countries get stronger in their currency, and that means they could buy more foreign goods. And so their inflation, actually, their increase in the value of their currencies could prove to prevent them from having massive inflation. But that's only if the dollar falls, which I believe it will, but it's going to be pretty slow getting there. One of the Facebook users says, how much longer can the Fed keep interest rates this low? I would say you're probably talking about, well, the answer to this question is they really should start allowing it to increase a bit. Economy's recovering, bond prices are going up. But the biggest problem that they face is that the federal government is so dependent on borrowing, and its cost of borrowing is so high that it's going to be, an issue. And I just think that the Fed can't raise rates because it's going to make the US government absolutely bankrupt. So it's going to be a while. Sean says Yellen is overstepping her role. She is sending wrong signals to the market. She has zero credibility in the market. She is the Treasury Secretary, not the Fed chairman. So generally, the Treasury Secretary doesn't put too much pressure on the Fed chairman. So yeah, I could see what you're saying. Her credibility, yeah, I would say she was handling a relatively easy time. Crichton says, also, do you think automakers will actually invest in microcontrollers? The silicon chip shortage could end before they ever put microcontrollers to use. Yeah, I like what you're saying there, because I think what you're saying is, wait a minute, don't necessarily believe everything that a company says. They're saying they're going to make that adjustment, but making that adjustment may be much harder than what they thought. All right, next question was from Titigon. Do you think the PE average level of acceptance already moved up for stocks? Yeah, I definitely think that people are more willing to pay high PEs. If you go back 10, 15 years, people weren't that willing to pay high PEs. So there is some acceptance. But truthfully, when markets crash, those PEs are going to be in trouble. So Robbie Jacobs gives me an exclamation point. So I just want to thank everybody for your questions. That's an update of the news for the week. I hope that everybody has a great remaining time in your Friday, and that you have an amazing, amazing weekend. I will see you all next week. Have a great weekend. Spend some time with your family and relax. I'll be spending time with my mother.